So hi, this is Archna. The topic that I'm going to discuss is risk management and strategy diversification. Um, the reason why I'm doing this is because everybody just talks about only calls and puts. So I thought, what way other than, how do you define risk? Somebody is willing to lose 10,000, somebody is willing to lose not even $10. So that's why this is my topic. And I think in this market, this is the most important thing to do. So let's get started. First, disclaimer, trading is risky. All the trade setups that I talk about on my website, on my Twitter account is only for educational purposes. And I'm just going to be explaining some strategies that most of our traders use for risk management. But it is your capital, it's your decision. Okay, so be careful. About me, I run a live real-time trading Slack channel for Laduk trading, and it mostly focuses on option strategies based on certain levels. What kind of strategy is most important in terms of efficiency of capital? I also have my own company called Archna Trades. I have two different offerings where I am doing Twitter trade alert subscription and one-on-one options mentoring program. I also write articles for Bar Chart as a contributor. So how did I get started? Um, I started like many do into technical analysis, learning all the candlesticks and everything, head and shoulders and all kinds of technical analysis I did. But in 2012, I'm from Chicagoland. So, Dan Sheridan, he was a CBOE market maker. He used to do these small group courses and teach everybody about, all the volatility strategies and income option strategies. So I learned everything from him. I did a big course. And I got to see a different side of how options can leverage, um, and it can provide the capital efficiency. I learned everything about option Greeks and how you can actually bet on, the distribution curve. You don't have to be right. You don't have to be wrong. That's two different things of thinking about. When you are in options, um, there are only three things that the market can do, right? It can go up, down, or sideways. So if you buy a call, you know that the only way you make money is if it goes up. If you buy a put, you know that it has to go down, then only you make money. But because of all the strategies and learning the Greeks, I just do not have to be wrong. I, you know, two different things. I have to be right versus I do not have to be wrong takes care of uh, two of the three possibilities, right? So that's what made me really fascinating to learn those volatility strategies. And then I'm like, okay, should I just look at the option chain and not do anything else with the technical analysis that I learned? That didn't make any sense to me. So then I combined everything and made it my own in the sense, yeah, I look at the option chain and I still look at my head and shoulders and everything. So it gives me better entry. I just don't look at the deltas. I even look at the candlesticks. And so I can get better entries or I can get better credits for my option strategies, and I made it my own. And so that's what I teach people. So let's get to the topic at hand. What is risk? Risk in financial terms is just right. The chance that an outcome that you expected won't happen. That's risk. But for me, I define risk as what I am willing to lose to get a particular return, right? If I'm not willing to lose, Even if it's a good setup, I'm not taking the trade. So that is how I define risk. Again, I may have a $10,000 account. You may have a $10,000 account. The risk tolerance is going to be different for different people. You may be fine taking, a $5,000 position in a $10,000 account. I may not be okay with it. So risk is different for everybody. Risk tolerance is different for everybody. So how do you define it? How do you take care of all these things? So people talk about position size, don't have huge positions, always live to fight another day, right? That's all talking about position sizing. To be actively participating, not only participating, be successful in trading. And if you have to make this as your career or, right, be able to do this full time, capital is your only asset, right? You can't lose it. If you lose your capital, you have no business anymore. You have no trading anymore. So we talk always about position sizing. One bad trade should not take me out of the game. Um, so that's the most important thing. But if you talk about $10,000 account, your 1%, 2%, maybe very small in terms of dollars, that you are not able to take a trade in Tesla, you are not able to take a trade in Netflix, it's a $1,200 stock. So do you not trade that then? So how do you manage risk in that scenario? Again, another way of thinking about risk management is play the stocks that everybody else plays, right? You trade Microsoft and Apple that are, the stock is also traded in huge volume. The options are traded in huge volume, which means the bid-ask spread is not huge. It's penny wide, maybe 5 cent wide bid-ask spread. So that makes it easy to get in, easy to get out. It also helps you manage your risk, because once you get in, you're able to get out. Right? So all this is fine. Having rules, high probability setups, having defined entries and exits, all these are good risk management techniques. But we've not gotten to any strategy yet. Yeah, right? So this topic is, how does strategy diversification help you with risk management? So let's get to the main part of the presentation. If you, right, as an individual, you take one trade, right? When you talk about taking one trade, what do you say? Oh, it has broken out. Let's say Palantir, it broke below 200, so I'm going to go short. The support is at 180. It is at 2. If it breaks 200, 20 points, I'm going to put $5 stop. So if it goes above 205, I'm out. Do I have? Yes, I have 1:4 risk reward. I can take puts, right? That's how most traders will think about any one trade. How much I can lose, what I can make, and do I have the in risk reward? That's one position. But what does that position do to your entire portfolio, right? When professionals have to take an additional extra trade, right? You may have 5 positions in your account. Now you get an alert because you put some alerts on your chart. Okay, Palantir crossed this level and you have to take the next trade. Now what are you going to do? You're going to still look only at Palantir setup. Yes, it broke this level, so I need to take this, and it is there, all that. But what does it do to your account? Is that the 6th position, right? After having 5 positions, do you need to still take the 6th position? How do you analyze that? So professionals manage risk at the portfolio level. How does this one new trade that I plan to take affect my portfolio's exposure to the market crash, volatility spike, or choppy market scenarios, right? You can see, like yesterday, the market went from 67.25 to almost 68.20. And today we are almost back to 6,700. So when yesterday the market was started bouncing, if you kept buying more calls, today you're underwater. So every new trade that you take, how does it affect your entire portfolio? That is what we'll talk about today. Okay. So because of that, you need to know the Greeks. What are the different Greeks? So let's talk about the direction Greeks, which is delta and gamma, right? Delta, if you know, it's the directional bet. It measures your exposure to the underlying price change. So if it's a 50 delta call, it behaves as though you have 50 long shares. That's one way of thinking about your delta. If you buy a 50 delta call, it changes, right? If the stock goes up $1, you theoretically, your option should go up 50 cents. If the stock goes down $1, theoretically, you lose 50 cents, right? You can look at delta even in another terms. What is the probability of it? What's the probability of the stock being in the money at expiration? So if you buy a 50 delta call, you are saying that it says that there is a 50-50 chance that this will be in the money at expiration. Okay, so delta measures the direction. It is going to measure how much net long or short you are. Okay, so if you have, say, 1,000 shares of, or let's say you have 100 shares of Apple, right? So shares will always be one, right? So you are 100 deltas long. If you have 10 contracts, okay, of Apple calls, okay, if you have 10 contracts with Apple calls, and each of those calls are 50 delta, right? So you're talking about, this is like 50 shares, right? 50 times, we talked about 150 delta call is 50 shares. So you have 50 times 10, you are controlling 500 shares, okay? Or 10 contracts long at 50 delta will show up as 500 deltas in your portfolio, okay? 500 deltas long you are. You are long 500 deltas in your portfolio. And now let's say you get an alert of even Palantir going higher. So are you going to buy the next? Which means if you're going to buy 10 contracts at 50 delta for Palantir, now you are 1,000 deltas long. If you think in that terms, it is like, right, you can beta weight your portfolio to see if SPX is going to have 1% down day, how much will my portfolio be affected? Okay. So all these, looking at your portfolio deltas will tell you how much long you are. And that is important. Okay. Next is gamma. Everybody talks about gamma. It is how fast your delta will change. It is the accelerator. Okay. This is the exponential leverage that you get with options. But if you do not know, it can go the other way too. Exponential means either you have exponential growth or you can have exponential decay, right, in your portfolio. So how fast the delta can change. High gamma, like in short-term options, is like driving a race car. Your exposure accelerates violently. It's the risk of being right or wrong too fast. Okay. So knowing what is your portfolio delta, are you long gamma or short gamma, will help you tell, okay, how fast or slow your portfolio is going to go up or down based on what not only your positions are doing, but what the market is doing in general. Okay. Then there is something which is theta and vega, right? Options are not forever. They are time sensitive. You are buying or selling calls or puts for a certain expiration, which means after that option doesn't exist. So theta, whatever premium either you've collected or bought, has to decay, because everything that is out of the money, okay, goes to zero, right? All option price that, option strikes that are not in the money will go to zero. So theta is either your income or your cost. It's the rate of time decay. If your portfolio is net theta positive, what does that mean? Theta positive means you are gaining the time decay, right? Theta is time decay. And if you're positive, that means as days passed, as the time passes, you make money. Why? Because you have sold time. You are making money with each passing day that the market is flat or is not going against you. If you are theta negative, time is your enemy, in the sense you have to be right now. You have to be right, and you have to be right now. Okay. So that's theta. Then something called as volatility, right? Vega measures the sensitivity to the implied volatility. So there are Vega positive strategies where as the volatility spikes, right, as fear increases, you make money. And there are Vega negative strategies where as volatility comes down or fear subsides, you make money. Okay. So these are all different Greeks that, knowing how they affect each other or how they affect your overall position, and that position, how it affects your overall portfolio, is important. Okay. Just doing technical analysis and buying a call or a put works for people. I don't deny that people don't make it do with all that only small information. There's so much to learn, right? If you are really good at, okay, this is my one at 5-minute chart, I look at this, I do this, I do that. If you've done it, well, good for you. It had not worked for me. And so I went ahead and got more knowledge. And now I see how the market is three-dimensional. Okay. And how one position affects the other and how one Greek affects the other. It gives more perspective and it helps me sleep, because I have diversified based on all these different Greeks, my portfolio. So let's talk more about it. Okay. How do these Greeks interact with each other? Okay. A simple long call, you are long delta. What does long means? Right? Delta is the direction. You are long the direction, right? You want it to go up. That's why we say it is long delta. You are long Vega. Why you are long Vega? Because as if volatility increases, option price will increase. So if you buy a call today and tomorrow the volatility increases, the option price will increase irrespective of where the stock is or is not, right? So at 15 IV, if the Palantir 170 put, right, we're talking about calls. So let's say 220 call in Palantir at 15 IV is $5. And if the IV of Palantir increases to say 20, the same 220 call with Palantir stock not moving even a penny would cost you probably $6. Okay. Just because the IV increased, the option price increased. So when you are long a call or long a put, then you want not only the direction to work in your favor, or that's why we say you are long delta, you want IV to rise. Okay. But it is a short theta trade, which means you are paying for the time, but you are long gamma. What does long gamma means? It accelerates. Okay. When you see, if you look at your option chain Greeks, right? And you look at gamma, if you buy a call, it will show plus 0.00578 like that if you have, right? So, which means that every delta increase will, so how does that work? If you have bought a 50 delta call and the stock goes up $1, it's not only that you increase your theoretical price says that your option will increase 50 cents, right? But then what now? Your delta, if your gamma is say 0.1%, right? Just say 25 cents, I'll just say, just to make it easier, which means that 0.002, right? Your delta is now 52. Okay. So now for next $1 that your delta stock price increases, now you are going to increase in 52 cents. And then delta was say 0.25, right? We're talking about so 25, right? So you're talking about it's going to be 54.5 now. So the next time it increases, now your option price is increasing by 55 cents. Okay. So that's how it becomes exponentially, it increases. Your option price increases as the gamma and the direction increases. If you are right in direction, the long gamma makes it as though you you started suddenly running, you press the accelerator and the gamma makes it go faster. If same way, because you're long gamma, if you're wrong in direction, initially you will see you're losing less, but then the gamma kicks in and you lose faster. So that's how we talk about when you buy a long call, you are long delta, long vega, but short theta and long gamma. I should have made this green long. Okay. A simple iron condor. Okay. An iron condor is a delta neutral strategy, which means no direction. Iron condor is saying, okay, that I think it's going to be sideways or choppy, or I know that it doesn't go this high, or I know it doesn't go this low. So wherever you think it doesn't go, you are selling something over there. Okay. So this iron condor is a short vega trade. Why is it short vega trade? Once you've sold, so after that, so once you sell something, you already got the premium, you got the credit, you already made the money. Okay, they gave you money in advance. Once somebody gives money in advance, and then if the IV increases, the premium increase, which means now if you have to buy it back, you have to buy it at a loss. Okay. So if you are short vega, you want the volatility to drop. So today with SPX, we were at 20 IV, right? The VIX was at 20. Tomorrow, if we gap up, so if you sold some put spreads today thinking that we gap up, and if we do gap up and the volatility comes down from 20, VIX tomorrow opens up at 17, you are good to go. Okay. You've made money on your put spread that you sold. And we are long theta over here. When you're long theta, you profit from time. Every day that you are not wrong, you make money. And again, you are short gamma in the sense that if it moves too fast, the gamma hits you because the acceleration occurs in your delta, and because you're delta neutral, it goes against you. Okay. So the goal, if you understand how each strategy is, okay, if you buy a call and if you have some iron condors in it, you are not right. You may think you have Apple long, and then you think Palantir is also going to be a long, but then why have too many longs? You could do the same thing by selling something against it. So if the market is not going to be super bullish in one direction, you are still going to, make money because you have some long theta trades, you have some long delta trades, you have some short vega trades, right? So if you know that, you are not going to be, you are never going to have big up, big down days in the market, okay? The goal is that you cannot be long everything. Diversification means building a portfolio where these forces are balanced and not concentrated. Okay. So, how do I think about this diversification and what is my framework? Okay. I use strategy buckets to balance my Greeks. Okay. So, theta positive are my income strategies. Okay, theta positive means is as time goes by and as I keep saying that I am not wrong, those are two different things. It's a different mindset. If I'm directional, I have to be right. But if I am selling a credit spread or selling an iron condor, right? Doing an iron condor, then I don't have to be wrong, which means it can go sideways, it can go up a bit, it can go down a bit. I just don't have to be wrong bigly. Okay. So if you sell a credit spread or do iron condors, they are theta positive, negative vega and negative, or short vega and short gamma trades. This is best used in high IV, range bound, or choppy markets. You are betting that nothing will happen and collecting premium as time passes and or IV drops. Okay. Like today, I did an Oracle put credit spread. Oracle was at 324, right? And kept coming down. Now it's at 240. It filled the earnings, it filled the gap, right? I'm like, okay, it's done almost $100 pullback. Right? I went out 45 days out, sold some put spreads. Now, tomorrow, if it is going to go a little bit down, but you understand the direction is now working as theta, right? That if the direction goes wrong, but it goes slowly down, the theta is there every day that it doesn't go very fast towards my strike, I'm still going to be okay. As long as my short is not breached, it's going to slowly decay. The option will decay, and whatever credit I got, I can keep, right? So you are betting that nothing will happen and collecting premium as time passes or as IV drops. There's something else you could do is cash secured puts or right. If you want to buy something, right, that's the way to do it. If you want to buy some stock and you had not gotten it in before, sell puts against, right? Sell puts and keep the premium. And if it goes down there, you get put the stock. If it doesn't go there, you made income on your cash. So these are my theta positive income strategies. Okay. Now you can see over here, two different things, right? It's a positive theta, negative vega trade, like the credit spread. And so that is the reason why I say these are theta positive income trades. Every day that I am not wrong, I am making money. Okay. And so, for example, this is another trade I sold, right? Boeing has been slowly coming down. Okay. It came to the 200-day moving average this was taken 2 days ago or yesterday, I think. Okay. And this is my anchored VWAP at 189. Okay. So what? I sold 185 puts and I got a credit of $5.02 of $5.20. So, right, if we keep going down, which means it has to break the 200-day, it has to break the anchored VWAP, it has to break this another yellow line of mine, right? It comes here, keeps going down. That's when I get put the stock. And if I get put the stock, I will get what, 185 minus 5.2, right? $5.20, which means my cost is going to be $179.80. Are you willing to buy at that price? It is almost, before where it was Liberation Day, kind of, right? May 2025. Are you willing to buy Boeing at a price where it was in May 2025? If the answer is yes, right, and you're getting good enough credit, I sold puts I didn't have any Boeing in my IRA. This is how I do it. Okay. I sold puts. Now what? The little bit of cash that I had is being used up, right? And if Boeing goes higher in the next few days, this 5.2 credit that I got, $5.20 credit that I got, is slowly going to decay. And I can $3, $2, I can buy it back at $2, $3, whatever. And I made $300 in my IRA as income. If I get put the stock, I did not have Boeing in my IRA. I wanted it. That's why I did it. Okay. So, but then this is showing you that you are getting paid to wait. You are getting paid to not be wrong. You are getting paid to just for it to decay, right? So that's how you could do. You don't have to do all these trade. Boeing also selling puts, Apple also selling puts, Palantir also. You're not doing it every day, every time, all these things. You are going to put it in balance, right? That's how you have to do it. Another thing, think about it. Okay. This was taken yesterday night. Okay. A Meta iron condor. Okay. Now Meta gapped up big. 1, 2, 3, 4, 5 days. It's either gone down, slowly been going down. Now this is the gap, earnings gap that it had. Now, if you want, okay, I think it cannot, 600 should be support. Okay. And it's very close to 600. So let's sell a put spread here. This gap is too big for it to fill in one go. So sell a call spread here, sell a put spread here, make it an iron condor. And if you did that yesterday, right? 675, 685 call spread you sell, and 600, 590 put spread you sell, you are getting $5.27 credit. Okay. So it's like, right? Meta cannot be up at the same time and down at the same time, right? So I am risking $1,000 here because it's a $10 white call spread and a $10 white put spread, right? But it cannot be up and down at the same time. So I'm risking $1,000 over here per contract, but I'm getting $5.27 credit for this. I am risking less than that. So from 1,000, you take away 5, right? Or from $10, you take away 527. I am risking $4.73 to make $5.27. So yes, IV being high is an advantage, right? When IV is high, you are risking less, but getting a bigger credit. You get it? So over here, doing this trade now, as long as by December, which is in 40 days, it doesn't breach this and that, right? These two levels, it cannot go above 675 and it cannot go below 600. I can keep this entire credit. There are different ways to manage it. You can, once you see bouncing, okay, then you get rid of one leg. If you get challenged, there are ways to adjust it. But this is me just trying to show you that don't necessarily have to always buy calls and puts to make money in the market. Okay. You can do these things. And people always say, oh, credit spreads and everything, you risk more than you make. No, it's when you sell those credit spreads matters. When the IV is very low, they are not expecting big moves. And when they're not expecting big moves, you're not going to get big credit either. But now that we are having the market IV is high, Meta has had a big move. So going forward for the next few days, next weeks, right, the IV expands. And because the IV has expanded, I am getting more credit. And because I'm getting more credit, my risk of doing this trade has now drastically gone down, right? So that's another way of thinking about it. So that was my bucket one, okay, which is theta positive trades. This is Vega positive trades, where I do calendars, diagonals, long straddles, and strangles. Okay. Now, what is a calendar and a diagonal? Here you're taking care of different expirations. Okay. You do something in November and do something else in December. You sell in November, buy in December. Automatically, because you're giving yourself more time with December, but giving less time with in November, different things happen. Okay. So you can configure diagonals and calendars and all these things in so many different ways, right? When I mentor, I always tell there are only 4 things that you can do is buy a call, sell a call, buy a put, sell a put. It's only 4 things, but in combination of these, how many contracts, different strikes, different expirations, how you combine them, you can have endless possibilities. Okay, which means you can actually bet on the entire, right, on if you think about the normal distribution, the bell curve, right, you can bet on one part of the bell curve by doing different strategies, right? So calendars take advantage of this time. It's mostly theta positive and positive Vega. So if the IV is low, right? So let's say we know earnings have been coming now, but that's in October, November, earnings are there. So you could 2-3 weeks before the earnings, right? Now, let's say NVIDIA is having earnings on November 19th. Maybe mid-October or just end of October, almost 3 weeks before NVIDIA earnings, you could buy the November 21st option, right? That IV has not yet risen. The IV for that November option has not yet risen. And you can sell the near dated option against it to make it either a calendar or a diagonal in whichever direction. You can do a put diagonal or a put calendar. But this kind of setup, right? The near dated option decays faster. The premium decays faster. And further out in time, the theta decay is slower. Plus, further out in time, you're looking at NVIDIA because earnings are coming up. There is some kind of event risk going to come, which means Vega can rise, right? So you've sold something when the premium is going to decay faster. There is less risk left now in terms of what this it will do. So all that decays faster. So what you sold expires worthless, and now you have a cheaper call or a put for earnings, and the IV is expanding. Okay, so that's one way of doing a calendar or a diagonal. Then when you know that there can be big events, right? Tesla was going to have the board meeting today for Elon Musk, right? Package. You don't know what the vote is going to be, and you don't know what the reaction of the market is going to be. So, but you think Tesla is going to have a big move, either up or down. You don't know. So then you buy long straddle or a long strangle where you are using the positive Vega because of the unknown. The way, right, volatility will expand, and you have positive gamma because you're doing long. You're buying a call and buying a put because you don't know which direction, but you know that there's going to be a big move. So you could do a long straddle. So these are Vega positive strategies called volatility strategies. Okay. So this is just one example of how a calendar is set up. So think about it in terms of Morgan Stanley. It has been consolidating. Okay. On earnings, it gapped up. You can see this red candle. On earnings, it gapped up, but this was the resistance. So it couldn't go through, came back to fill the gap and slowly went up, but it had been consolidating all this while when the market had been going down, right? We've been having a volatile few sessions in the market. It has been consolidating, but it has not been able to break through this resistance. So we are at 166 somewhere. Okay, so I sold the November 14th 170 call and bought the November 28th 170 call to form a call calendar, and I paid $1.25 debit. Okay, so you can see that the IV for the shorter date, November 14th, was 34, but November 28th is 27. So the difference in the IV, or right, is I sold the higher IV, bought the lower IV. That's why it's a Vega positive trade, right? Plus, it is theta positive because the November 14th 170 will expire. The premium will decay faster than the 28-day out premium will decay slower. Okay, so you can see that November 14th option loses 0.1257 of the premium every day versus November 28th option loses only 0.0856. Okay, so it is a theta positive trade every day that Morgan Stanley, because this is a call calendar, every day that it doesn't fall big, I'm making money. Once it breaks out, right? If it breaks out slowly, I'm still making money. The only time I'm losing in a calendar or a diagonal if it does something very fast, because then the Vega changes so drastically that it goes against me. Okay. So now another bucket 3 is the delta based or directional strategies where you look at long calls, puts, okay, and debit spreads. So you are taking a direction and direction is also needed. That's where, right? If I just did income strategies and volatility strategies, I won't be able to eat anything. That is, you need that, sure, but then you need the convexity of options. Why am I an option trader if I don't use the convexity and the reflexivity that the options provides me? So of course I'm doing long calls and long puts and debit spreads to have prove the direction that I want to take, right? And make money that way. So that's the third direction. Now, how do you balance it in a portfolio? Okay. A balanced portfolio smooths out the equity curve, which means you don't have big drastic moves. You're not going to have, if the market is down 3%, yeah, if you had all puts, you are probably making, right? If the SPX is down 2% and you are making 100%, you have only puts, you're making 100%. True. And if the market is up and you're only long, true. But if you are wrong in any way, how do you smooth that out? So you can have a combination of income strategies, directional strategies, and Vega bets, right? Do some credit spreads, do some calendars, and still have your directional bets too. So having a 30, 30, 40, where 40 gives me the convexity, the directional bets. And then for days when market is doing nothing, which is very few days that, right? Markets don't do, even if, okay, SPX may be having a 0.2% up day, you are always going to have some name like Palantir or maybe USAR or Oklo that runs big. That's where this 40% comes in. But then every day SPX and Apple are not doing 1%, 2% updates, right? So that's where this 30% and 30% of Vega positive and Theta positive trades help me, right? Then I don't have to worry much about my portfolio, and I do not have to worry about making money every day, because there are some positions where I sit on my ass and it's still making money. Okay, so the takeaway over here is everyone has a different risk tolerance, but to be able to trade successfully, risk management is key. Using different strategies in different market conditions is a form of risk management. Based on different market conditions, you have different strategies. So strategy diversification buckets can expand or shrink, right? Right now, if volatility is high in the market, I am having puts, which are my directional bets, okay? I'm doing some kind of income trades by selling some puts somewhere, selling call spreads in some places based on what um you know chart is saying, like, I showed Boeing, I don't mind owning it, so I'm selling puts in it. But in Meta, I'm doing an iron condor, right? But I'm doing no calendar or diagonal right now because volatility is high. I'm not doing that, right? Because calendars and diagonals don't like huge moves. So I'm not doing that. So yes, my strategy diversification bucket is not always perfect 30, 30, 40, but I do all these different strategies to keep some kind of balance in, it's not that, if I don't open my account every day to look at it, it's never going to be that, oh, something huge happened, but having some theta positive and vega positive trades definitely help your portfolio to remain balanced. It definitely helps your portfolio, right? At least my portfolio now doesn't have that, you get up and one day SPX is down 100 points, you're not going to have huge drawdowns. Not only because I am definitely being careful as to what positions I'm taking, risk rewards I'm having, But because of this strategy diversification, because I am always looking at my portfolio deltas, comparing them, beta weighting them, and working towards managing portfolio as a whole, not looking at one trade in isolation. Okay. So if you liked any of the content and would like to have access, you can use this coupon Women20 at Archna Trades for any of the offerings that I do. And you can follow me at Twitter at Options Butterfly Queen. And you can look at my website. If you have any questions, I'm here to answer. Otherwise, I'm done. Thank you so much. Any questions? Okay, nobody has any questions, so then I can stop. I know I'm a little bit early, but there's only so much that I can talk about managing portfolio without giving more and more examples.